Hi, everybody. Thank you for taking the time to listen in on this episode of Market Pulse. We're here with Bepin and Mike Sorrentino, and we're officially in the summer. We made it. And I really hope those of you that remember the old adage of sell in May and go away, I hope you ignored it, because if you did, we just had the best month of May since what, 1990, I want to say.
Yep.
Yeah, 1990. So it's been a little bit over 3 decades here. But we're in the summer. We're in the
Yep.
summer. Stocks are back in a direction I think everybody's happy with, even the traders.
Yep.
And I thought we would this week we would take a moment to go to one of the most boring places we could ever talk about. I think Beth and I are going to do our best to make it interesting. The bond market. The bond market is something, when I got my start, Bevan, I was actually working, in New York, and I wanted to be in the equity market. I want to be in equities. I was so focused on stocks, because that's where all the excitement was. Who cares about
The
bonds? They're
bonds. Yeah.
so boring. But then I noticed a lot of my really, really smart, like those analysts that were just gifted, they all, for some reason, went to the bond market. They started trading bonds. I'm like, why? Like, why aren't you over here in my fun world where we're always on the news? It's exciting. But it turns out you can actually do really, really well in bonds. And ironically, at the same time, the bond market tells us in many ways so much more about the overall macroeconomy than the stock
hmm
market would. So it is important to check in. It is important because we also run very diversified portfolios here, and bonds are a large component of that. So we're going to start by a quote, one of my favorite quotes in finance from Shelby Davis, very famous investor. You make most of your money in a bear market. You just don't realize it at the time. Yes, the whole adage of buying when everybody else is running away. Okay. And right now, I mean, Bevin, please feel free to debate me. Bonds have not really been all that. There's
I
not been a
don't.
lot of excitement about bonds.
I don't think there's any debate to that, obviously, and
Yeah,
I'm sure a lot of our clients even understand that by looking at some of their kind of balanced accounts. Where they for the last 3 years they've seen the stocks go up, 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 and then why aren't I keeping up? Well, it's the bonds.
it's the bonds. Yes,
Yeah.
yes, and after kind of a prolonged period of frustration, let's leave it at that.
hmm
Many investors often wonder, well, why am I in these things? They're not
Yep.
doing what the stocks are doing. If anything, sometimes they're hurting performance.
Yep.
2022 was the worst year for bonds in the history of the bond market by a factor of four. Why are we
Armageddon.
still
Yeah.
in these things? Yeah, why? So we're going to talk a little bit about the current state of the bond market, and then let's put a bull case together. Let's see,
Yeah.
is there a reason to continue to own these things? Now, if you think about the bond market and the equity market, like I said earlier, the stocks are kind of back this year. That the red line on the chart, as you see, the market index here, that's the stock market through a rough time.
Yeah.
We have to understand that there's an extreme amount of volatility in stocks, but over the long run, you've been paid for accepting that volatility, and that's fine. There's nothing wrong with that. But I think for a lot of people, a lot of investors, particularly investors that are retired or entering into retirement, a pure equity portfolio is not always the best thing to think about. Right. So we have as asset allocators like Bepin and myself, we have to ask ourselves, how do we try to smooth that smooth that right out over time? What can we do in the bond market, even though it hasn't been that exciting, even though it has been kind of a drag on returns this year? The blue line, as you can see, it hasn't really been all that volatile. There's a great quote also that they say a bad year in bonds is a bad day in
Day in
stocks,
stocks. Yep.
right? And
That's
that's exactly
classic.
what you're seeing on this chart here is that bonds provide that stability. Bonds don't
hmm
have the ability to really go down 30%, in COVID or whatever else
I
happens. Like there's a lot of
I
more math on the bond market.
Ironically, you mentioned that 2022 was Armageddon, one of the worst years in bonds in history. That's about how much it was down. When you're looking there at the bottom of the U.S. Equity markets when they were down about 15, and that happened in the matter of like a month in stocks.
Yeah.
That was the worst year on record for bonds.
So then the question becomes, with a bad bond market, what next? Like what next? But furthermore, what is actually causing this?
Hmm.
And if you look at this chart, I think this is quite telling. I mean, there's a big red line on there. That line represents Liberation Day.
Yep.
And I'm going to take a step back here too, because a lot of times people ask, well, why are bonds selling off? Why are yields rising? And that yield rising after the red line, what that indicates? Okay, we'll have to do a little bond math here. I apologize, but we got to do a little bit of math. When yields on bonds are rising, that means the bond prices are coming down. They're being sold. So it's an inverse relationship that we got to remember. So when we see bond yields rising, that means the
Hmm.
bond market is actually selling off. So what we saw after Liberation Day was, for all intents and purposes, a bit of a reversal in yield. So the
Hmm.
question then becomes, well, why did this happen? I mean, I don't think there's a coincidence here that that it happened right around Liberation Day. But at the same time, we do have to kind of remember that we don't really always know exactly why the bond market does what it does. When you sell a bond, it's like a stock. Like when I sell stock, they don't ask me why I'm selling it, right? So when I used to work on a trading desk in New York, and we would get calls like, "Hey, what's going on in the market?" We would call out, we would go over our traders and say, "Hey, where are you seeing flows and what's happening?" And they would say, "Okay, well, this big fund is doing this and that big fund is doing that," and we'd get a pretty good sense of why they were trading and selling. But today the markets are all electronic. You don't really know what's really happening. So what we're going to do is Bep and I are going to talk about what we think is happening in the bond market, but
Hmm.
ultimately it's hard to really know for sure. And if you see what we've seen since Liberation Day is there are concerns. Trump got in office and he campaigned on the idea of fixing the finances of the government. Elon and
Hmm.
Doge were cutting costs, or there were a lot of headlines around getting rid of a lot of the waste, and
Hmm.
all these things are happening along the way. So a lot of, I think, optimism got baked in the market, and then Liberation Day I think spooked a lot of people because of the tariffs that Trump announced.
Yep.
And then there's obviously we talked a lot about tariffs and the
Yeah.
uncertainty that they brought us. But ultimately, you start thinking about, well, maybe that stuff got priced in too early. So there is concern about inflation, particularly around the tariffs, even though we don't necessarily think it'll happen. There
Hmm.
obviously are going to be price adjustments to a degree.
Yeah.
The deficit, I think, is a big deal, particularly right now with that big beautiful bill that's trying to get passed through Congress.
Hmm.
There's some concerns around the deficit there. And look, I mean, and I don't almost don't even want to mention it right now. I'm afraid to say it out loud, but the Moody's downgrade, right? I mean,
Yeah.
talk about being late to the party, but I mean, ultimately, you have all three major rating agencies have stripped the U.S. of their perfect credit rating. At some point, I think even some of the investors out there, or even some of the politicians, or the just general buyers of bonds who have always looked at the U.S. and be like, it'll be fine. They'll figure it
Yeah.
out. You got to be thinking that they might be saying, hey, you know what? I want to get paid a little bit more for taking on this risk. They got to be thinking that, right? So that's
For sure.
ultimately, I think, what's happening. And if you go out and look a little bit further down what we call down the curve into
Hmm.
longer dated bonds, it gets way more interesting, in my opinion, because what we're
Yeah.
seeing here is not just a rise in long term yields in the U.S. Bevin, we're seeing that in Japan, and like this is a global trend of
Yeah.
investors saying, I don't want to be too dramatic here, but enough is enough. And if you're not going to fix your finances and you're going to expect me to pay for that, I want to get paid a little bit more. And I
Yeah.
think what we're seeing is exactly that.
Yeah, no, it definitely is. And as you've seen across the world here, with Japan being kind of like a proxy for the Asian markets, Germany being a proxy for the EU, two of the larger, more developed economies on earth, everyone wants more money to hold government debt. They want more interest. That's a little bit more cushion for them in case there is more runaway spending, in case there is runaway inflation in some of these economies. They want to be compensated for that risk. But I know we just got through talking about all the negative picture around bonds right now. So the next few slides here, we're going to try to convince you that you should continue holding, and in fact, maybe even be buying some bonds. So the chart you're looking at here, we're going to do a little bit of bond math, but not too much. You're looking at yields in the blue line, which is the the yield of the US aggregate bond index. And on the green line, you're seeing the 5-year forward return. And as you can see, the green line matches the blue line pretty closely. Actually, they have a 94% correlation. So today's yield in the US aggregate bond index has a very high predictability of your future returns. So today, currently, they're actually closer to like 4.5. This chart is as of the beginning of the year this year. So it's showing the current yield at 5.1. Bonds have had a pretty good year, or a decent year so far this year. So that's come down a bit. But 4.5% return over the next 5 years isn't bad at all, particularly for retirees. So if we know that this is the predictable power of the current yield, we can not guarantee by any means, but we can have a high probability that that 4.5% is what we're going to get in terms of return over the next 5 coming from here. So the high starting yield should be very attractive, particularly for people in retirement or nearing retirement, like Mike was talking about. Guess what you need? Income. And getting income off of your bonds helps quite a bit when, let's say, stocks are down. So the yield is very nice to have.
Another reason why I like this chart so much, Bepin, is that if you go back to 2020, I made one of the we don't believe in timing markets here, but the bond market is a unique animal in many ways, where things, when they get into extreme circumstances, it becomes highly predictable in my mind because of the way the bond math works. And excuse me. And in late 2020, I made a very public call. Actually, I was talking to a reporter at the time. I was like, get out of bonds and get out of them immediately. And she's
some
like,
of you at home may.
Yeah.
Well, we did that in our models. That's we were actually very light on bonds going into 2021, which really did help. Obviously, as 2022 came around, but
and it wasn't some macro call. They kept asking, well, why are you making this call? I'm like, because it's math. Bonds can't go any higher. They just mathematically, there are certain laws of gravity that exist in finance, and this is one of them. They can't go higher. So if they can't go higher, they can only stay where they are or go lower. And I don't want to have dead money in something like this where I can have dead money in cash. And end up being one of the best calls we made in our portfolios because of nothing more than just understanding what we're seeing on this chart here.
It's honestly as simple as that. Yeah,
it is as simple as that. Now, are we at the exact extreme end of the situation on the opposite end? No. I don't think so. But to your point, Bepin, there is a very interesting opportunity building right now.
Yeah, exactly. And one of the more interesting parts is that obviously what made 2022 very painful was that you had stocks and bonds selling off. So when you're talking about correlation in that type of time period, they have a positive correlation, meaning they move in tandem. Stocks go down, bonds go down, bonds go up, stocks go up. Now, what historically, when you see stocks and bonds, is that they're typically negatively correlated. So what does that mean? That means when stocks go up, bonds go down. When stocks go down, bonds go up. So they tend to be very good hedges for our downside. Like we were talking about that income play in the last slide, where when your stocks are down, at least you're still getting income from your bonds, and you can use that to fund your retirement. In this case, what you'd really like to see is that when your stocks are down, not only are you getting income from your bonds, you're also getting some downside protection. People are flooding to safety. They're getting out of their stocks as the market goes down and going to the perceived safety of bonds. So they can act as a bit of a cushion should we see some increased volatility in the future, or maybe we do see a recession. We did have that negative quarter of GDP, which of course was a very import driven, and obviously the estimates for Q2 are all the way back and heavily positive. But should a recession arise, bonds might be our best friends in that environment, because you don't have that risk of rate hikes, which if we go to the next section, Fed cuts have been delayed, obviously, which if you'd looked in like the summer of 2024, had you asked them what they were going to do by the end of 2026, or actually this year, 2025, I think at one point it was expected to be 6 cuts, right, Mike?
Yeah, that's right. 6 cuts.
6 cuts. Right. At this point, we should have already had 2 cuts, but that's not how the situation unfolded. But what you're looking at on your screen here is the summary of economic projections. One of like the little like code names for it is the Fed dot plot. So let's just look through how you'd read this thing. Over on the left-hand column, that is the target for the federal funds rate. each of those little green dots you're looking at the bottom there, the x-axis is that year end of 25, year end of 26, 27, and then eventually the long run, which is just some long-term date in the future. It doesn't really have a particular date. They just think that this is where race will eventually be. Each of those dots is where a particular member of the open market committee, they're the ones that vote to decide on if they should cut rates or hold them or raise them. That shows where they expect rates to be by the end of the year. As you can see right now, there's a heavy congregation in 2025. They still expect 2 cuts. This is as of March of 25. Now that could change. Obviously Liberation Day occurred after March 31st. And then there's also just so many different variables that can happen over the next year. Geopolitical, anything could really occur. But what they expect over the next 2 years is, as you can see, where this trend basically just follow the biggest group of dots, and you'll see where they really expect it. So 2026, they're expecting it to be around 3.5 to 3.25, getting even lower by 2027 to closer to 3.25 to 3. Eventually, they expect it to settle around 3%. So currently we're at 4.5 to 4.25. That'd be another 6 rate cuts from here to the long run. Now that of course can change, but the general trend here that you're looking at is that they expect rates to come down. I don't think there's been much talk about people saying that actually we think rates might need to go up. So what happens with bonds is a little bit more math here, but when interest rates in the open market go down, the value of your bond goes up. And so the price people are willing to pay for that bond increases, which can add to return. And quite dramatically. So the longer term the debt is, the more of a price appreciation you see when rates get cut. So this is another, this is clearly another bull thesis for bonds, but it's been delayed a bit, but we know it's coming. So it's one of those things that you can't try to really time it. These things change too often, but we know the general direction, which is rates are coming down.
That's the key right there. What you just said is the key. It's that don't focus on those dots. Don't focus on when they're coming. Just know that over the long run, 2 things: that we are expecting rates to come down at some point. We don't know when. And when they do come down, that is going to be a natural tailwind to the bond market. I won't say a rising tide lifts all ships, but it is certainly going to help a very large swath.
Yeah, exactly.
Exactly. Most ships, except for the
go
ones that have made really, really bad holes in them, or maybe hit an iceberg. Everything else is going to be in a pretty good spot.
Exactly. And then lastly, this is the last real major point we have, which is that what the chart you're looking at here is on the top there, the blue line is showing you the bond future prices. Essentially, you see that line going down. It's been a very tough 3 years for bonds. And that orange line there is kind of showing you sentiment. So a way you can read it, don't focus too much on what exactly is the math getting you the sentiment there. If it's above that top blue dotted line there, it means that everyone is pretty bearish. So they don't believe bonds are going to do very well. If you see it below that second bottom dotted blue line, that means they're quite bullish on bonds, or at least they're not worried about them. As you can see right now at the top right of that orange line, people are extremely worried about bonds. So this chart here is actually breaking down what would have happened had you invested during those time periods, invested during those periods where the reading was above 64, which is that top blue dotted line. And then what happens when they were below 41, which means when people were bullish. And as you can expect, when everyone was scared, the returns ended up being very good for you if you were willing to look past that fear and buy or continue holding. And if you were buying only when the sentiment was positive on bonds, you actually did quite poorly. The average return was minus 25% per year, which is kind of insane on bonds. That's catastrophic type returns to be losing
Horrific.
losing a quarter of your money on a bond investment. But it just goes to show that classic adage where it's just you want to be buying when there's blood on the street. And like Mike said, there isn't another period in time where there's been more blood on bonds. So that's why we've been continually trying to increase our allocation when we can, and definitely not looking to abandon bonds by any means, particularly in retiree portfolios. But just looking at the sentiment across the market, this alone should be an all-time screaming buy signal. I mean, when everybody agrees, they're all wrong. It's almost a guarantee.
Every time. Every
Yep.
time. Yeah. Remember, I mean, and it's not, to your point, Bevan, it's not just stocks or bonds. I mean, do you
Hmm.
remember going into 2023, there was a 99% probability that we were going to
Recession.
enter a
Yeah,
recession. Yep.
I know.
And never
Yeah.
happened.
And that's where it's almost the biggest giveaway in the market is if you see 90% on anything, there's nothing that has 90% certainty. Not even like the sun rising could come at a 90, actually probably a little higher, but there's just not any too many certainties in this industry, in the
Not in
financial
finance.
industry. Yeah, there
Yeah.
might be some certainties out there in nature, but there's not too many in finance. And when the market starts pricing in certainty, it'd probably be a safe bet to bet against it. And with that, we'd like to thank you for tuning in. As always, if you have any questions, feel free to reach out to us. We hope you guys have a great weekend, and we will see you on the next episode. Take care, everyone. Thank you.